There's a specific dangerous moment that happens to almost every new investor. It usually happens late at night when the house is quiet and your defenses are down. You're scrolling through a stock screener or browsing a finance forum, looking for a place to park your hard-earned cash. You look at the blue chip giants. You see Apple, it pays a miserly 0.5% dividend. You see Coca-Cola, a boring flat 3%. It feels like watching paint dry. You do the math in your head and you realize that at 3% you will be 80 years old before you are rich. And then you see it. It's glowing on the screen like a beacon. A company you've never heard of. Maybe it's a mid-cap shipping firm based in Israel. Maybe it's an obscure mortgage trust in Florida. And next to the ticker symbol, it promises a dividend yield of 18%. You stop scrolling. You lean in. Your brain does the math instantly, faster than a calculator. If I put $10,000 into this, they will pay me $1,800 a year just for sitting there. If I put in $100,000, I could practically quit my job. It feels like a glitch. It feels like you found a cheat code in the financial matrix. You ask yourself, why would anyone buy a treasury bond for 4% when this random company is handing out cash like a drunk uncle at a wedding? You feel smarter than the market. You feel like you found the secret that the Wall Street elites are hiding from you. I have bad news for you. You haven't found a cheat code. You have walked into a kill zone. That 18% yield isn't a gift. It isn't a sign of a company that is overflowing with profits. It is a scream for help. It's not generosity. It's a bribe to get you to hold the bag while the smart money runs for the exit. Welcome to the world of the yield trap. Today I'm going to show you why the highest paying stocks are usually the worst investments you can make, and I'm going to show you the one simple number, the lie detector, that will stop you from losing your life savings. To understand the scam, you have to understand the math behind the curtain. And don't worry, this isn't calculus. It's a simple seesaw. Dividend yield isn't a fixed number set by a benevolent committee. It is a dynamic calculation. It is the annual dividend divided by the stock price. Let's say a company pays $1 in dividends and the stock costs $20. That's a 5% yield. It is healthy. It is normal. It is boring. But watch what happens when the company starts to die. Let's say the big hedge funds, the people with satellites tracking supply chains and algorithms reading earnings reports, realize this business model is broken. They sell aggressively. The stock price crashes from $20 down to $10. Now, here is the trick. Management is terrified. They know their stock is crashing. They know if they cut the dividend now, the stock will go to zero. So, out of pride or fear, they keep the dividend at $1. So now the math is $1 divided by $10. Suddenly, the yield doubles to 10%. To the uneducated eye, this looks like a bargain. You think, wow, the market is mispricing this. It's on sale. But it's not on sale. It's on fire. The yield didn't go up because the company is generous. The yield went up because the company lost half its value. This is what we call a value trap. The high yield is a warning signal for distress. But because you are blinded by the promise of monthly cash flow, you look at the worm and ignore the hook. You think you're too smart to fall for this? You think you would spot the difference? Let's look at a real body count. Let's talk about Zim integrated shipping. In 2021 and 2022, the world was in a supply chain crisis. Shipping containers were scarce, and rates were at all-time highs. Zim was printing money, and they decided to pay it out. At one point, depending on your entry price, the yield was effectively over 100%. The internet went insane. YouTube finance gurus started making videos with thumbnails of exploding cash piles. "Retire on Zim," they screamed. "Passive income king." Retail investors poured their life savings into it, dreaming of a life of leisure. But shipping is a cyclical industry. It always has been. The boom is always followed by a bust. The smart money knew this. They started selling. The stock price began to slide. The yield looked higher and higher, luring in more victims. Until the music stopped. Shipping rates collapsed. Zim's profits evaporated. And then the inevitable happened. They didn't just cut the dividend, they eliminated it. Zero. If you bought at the peak chasing that yield, you didn't just lose your income. You lost 90% of your principal. The trap snapped shut and the money was gone. So how do you spot the trap before it snaps? How do you distinguish between a good opportunity and a financial suicide mission? You need a lie detector. In finance, we call it the payout ratio. This number tells you exactly what percentage of the company's profit is being sent out the door as cash. Think of it like your personal household budget. If you earn $50,000 a year and you spend $20,000 on rent and food, your payout ratio is 40%. You are safe. You have money left over to fix your car, save for a rainy day, or invest in your future. This is what a company like Johnson & Johnson or Lowe's does. They pay you, but they keep enough money to grow. But if you earn $50,000 and you spend $55,000, you are in the danger zone. You are borrowing on credit cards to pay for a lifestyle you can't afford. Eventually, the bank cuts you off. When you see a company with a payout ratio over 100%, run. It means they are paying investors more money than they actually make. They are literally liquidating the company, selling off assets, or taking on high-interest debt just to keep that dividend check coming. They are burning the furniture to heat the house. Eventually, they run out of furniture. The irony of dividend investing, the secret that the wealthy know but never tell you, is that if you want to get rich, you have to be willing to be bored. The stock market is designed to transfer money from the impatient to the patient. High-yield traps are designed for the impatient. They prey on your desire for fast results. The real path to wealth is something called yield on cost. Look at a company like Home Depot. 20 years ago, it paid a tiny dividend, maybe 1% or 2%. Most people ignored it, but Home Depot grew. They used their profits to open more stores, and every year they raised the dividend. A few pennies here, a few pennies there. If you had bought Home Depot 20 years ago and held it, your yield on that original cash today wouldn't be 2%. It would be over 50% per year. That is not a trap. That is an empire. That is how generational wealth is built. Not by chasing the highest number on the screen today, but by finding the company that will be paying you more tomorrow. So, the next time you see a stock paying 15%, do not click buy. Pause. Check the payout ratio. Look at the stock chart. Is it trending down while the yield trends up? Ask yourself, is this a gift from a generous CEO? Or is this a bribe from a desperate management team trying to keep the stock price afloat? Because in the market, if it looks too good to be true, it's usually about to cost you everything. Thanks for watching. Let me know in the comments if you want my personal checklist for filtering safe dividend stocks. Stay useful.